Brad Williams, Frugal Finance, calculating the cost of capital, default risk. The risk that a company might not be able to make its required debt payments, such as interest expense or principal payments. To estimate the cost of the funding that a company wants, we have to estimate the cost of debt. In this section, we look at the cost of debt. Cost of debt. The cost of debt measures the current cost to the company if they borrow money to fund projects. In general, it is determined by the following variables: the current level of interest rates. As market interest rates rise, the cost of debt for all companies will also rise. The default risk of the company. As the default risk of a company increases, lenders will charge higher interest rates, a default spread, to compensate for the added risk. The tax advantage tied to debt. Since interest is tax deductible, the after-tax cost of debt is a function of the tax rate. The tax benefit that accrues from paying interest makes the after-tax cost of debt lower than the pre-tax cost. So this advantage moves higher as the tax rate increases. After-tax cost of debt is risk-free rate plus default spread, 1 minus marginal tax rate. The challenge in estimating the cost of debt is really one of estimating the correct default spread for a company. Calculating the default spread. The easiest way to estimate the cost of debt is if a company has long-term bonds outstanding that are widely traded and have no special features such as convertibility or first claims on assets, skewing interest rates. The market price of the bond together with its coupon and maturity can serve to calculate a yield we use as the cost of debt. For example, this approach works for companies that have a large number of outstanding bonds that are liquid and traded frequently. Many firms have outstanding bonds that rarely trade on a regular basis. Given that these firms are usually rated, we can determine their cost of debt by using their ratings and assigned default spreads. Thus, capital construction with a Baa rating can be expected to have a cost of debt approximately 5% higher than the Treasury bond rate in July of 2021, because this was the spread typically paid by Baa rated firms at the time, right here. Some businesses are just not rated at all. The majority of private companies and many smaller ones fit into this group. In many emerging markets, rating agencies have proliferated. However, in many other markets, companies are not rated according to default risk. When estimating the cost of debt without a rating, one of two things can be done. Recent borrowing history. Countless companies that are not rated still borrow money from banks and other financial institutions. By looking at the most recent borrowings made by a company, we can get an idea of what banks are charging these companies and the default spreads, and use this information to come up with a cost of debt. Estimate a synthetic rating and default spread. An alternative is to play the role of a rating agency and assign a rating to a company based on its financial ratios. This rating is called a synthetic rating. To make this opinion, we start with rated firms and study the financial traits shared by companies in each rating class. So let's look at a very simple example. Using the operating income to interest expense ratio, which is the interest coverage ratio, and we computed it for each rated. In worksheet 1.9, we list the range of interest coverage ratios for manufacturing firms in each S&P rating class, arranged by market cap into large, greater than 5 billion, and small, less than 5 billion. We also show the default spread for bonds in each rating class as of July 2021. Let's look at a private firm with 10 million in earnings before interest and taxes and 3 million in interest expense. It has an interest coverage ratio of 3.33. Based on this interest coverage ratio, we would assign a synthetic rating of BB right here. Market coverage ratio, small market cap, what was that, 331? We would look at this information here. Here's the rating, BB. A large market cap firm with the same coverage would be assigned a rating of A- and a default spread of 0.84. Pretty crazy, huh? Just by being a small firm, you are subject to some serious price increases. Calculating the weights of debt and equity components. Once we have cost for each of the different financing pieces, all we need are weights on each piece to figure out a cost of capital. In this section, we consider the choices for weighting, the reason for using market value weights, and if the weights can adjust over time, estimating and using the cost of capital. With the estimates of the cost of the individual pieces, debt, equity, and preferred stock, if any, and the market value weights of each of the pieces, the cost of capital can be calculated. So if E, D, and R of S are the market values of equity, debt, and preferred stock in order, the cost of capital can be shown as K of E, E of D, and here is the formula. It's really straightforward. The cost of capital is a gauge of the combined cost of raising money that a company faces. It will usually be less than the cost of equity, which is the cost of just equity funding. Estimating cost of capital. Completing the analysis in this section, we first determine the cost of capital for capital construction. In making this estimate, we use the cost of equity that we figured out in example 1.2. Capital construction's cost of debt from worksheet 1.1. We also assume that the project is funded with the same mix of debt and equity as the parent company. Worksheet 1.10 provides estimates of the cost of capital for the self-storage project. This information is going to come from the general contractor information. And the numbers are going to be a little bit skewed because I probably updated the general contractor information. The after-tax cost of debt, this information here, if we find this, we're just going to subtract 100 from this to equal this. Cost of capital is just this formula. I showed you the formula earlier, and here we have these industry averages. You can go back to the previous worksheet, and the numbers, they only show engineering construction. That's why you're going to need to go to the general contractor, the 6 spreadsheets. I have all of these sectors shown. Now keep in mind, home building here is water in the general contractor information. Here we have this cost of capital breakdown. Anything in yellow is hard coded. You're going to put that information in there. Or you can equal the general construction information, or you can compute this on your own. And it'll be right here is 13.19. Now our after-tax cost of capital should be C106 times 1 minus 0.25. We have 524. We have a cost of capital of 12.88%. And how do we do it? Well, we're going to take the cost of equity, 105, times 1 minus C108, which is your debt to capital. We're trying to find the equity portion of this deal, and it should be 75% because it's 1 minus 25 right here, plus C107, which is our cost of debt. After-tax cost of debt is 5.24, and times C108, which should be 0.25. And that's the 25% that the GC is using in their line of credit or whatever facility they use. That's just the cost of debt. And then the risk-free rates. Brad Williams, Frugal Finance. Thanks for watching.